Well, good afternoon, folks. Welcome to this week's Wednesday webinar. I'm Don Graves, and there's my wife and my mother and my daughter on the screen. Actually, it's not. 5 ways the HECM for Purchase is changing retirement. Legal, ethical, moral, and compliant ways to add more savings into your client's retirement plan. A little bit about me, for those who don't know me. I'm the adjunct professor at the American College for Financial Services. I teach in the Retirement Income Certified Professional course. I teach in the Section 355, which is the third course. Currently, there are about 16,000 advisors working their way through the RICP designation. It's the fastest growing professional designation in America. And I can tell you great things about it. You should check it out. You can go to americancollege.org and find out more. 17 years I've been a home equity retirement specialist. In that time, I've had 12,514 conversations with clients that yielded about 3,000 people who actually became clients of mine over the years. 3 years in a row, that meant I did more reverse mortgages than any person in the United States for 3 years in a row. And you can find some of the writings and the research and videos through the American College at AskDonGraves.com. I'd like to thank our sponsor, Retirement Funding Solutions. They are my loan origination partner, the partner for these webinars, and they are the go-to resource for reverse mortgage loan origination. I say that honestly because I wouldn't send anybody to anyone else in the states that they cover. And our continuing education provider is High Point Law Offices. Today's webinar is eligible for PACE credits, PACE, P-A-C-E. It's not approved for CFP yet, but that's coming. So if you have an American College designation and you would like continuing education under PACE, please send an email to the person who invited you or myself, and we'll send you a certificate. Most people are familiar with this. It's a computer mouse developed in 1964 by Douglas Engelbart. A fascinating story about this, if you've heard me before, is that it took forever for anyone to pay any attention to Douglas Engelbart. Finally, Xerox takes it on in 1970 or so and said, well, we'll see if it does anything. But see, for the first time, you could use an instrument like this with that cord attached to move something on the screen. Never before, this was unheard of. You would use keystrokes or punch cards or things like that, but never could you move something and it would move something on the screen. And yet from 1964 until 1974, no one paid any attention until Steve Jobs walks into the Xerox Palo Alto Research Center, sees a demonstration of this, and he says to Xerox, you guys are using this, right? This is the future, right? They said, no, what do you see? And he jumps up and down, hyperventilates, leaves the room, comes back, and says, this is going to change the world. You guys are doing something with this, right? And they didn't. And then 10 years after that, 1984, 20 years after Douglas Engelbart developed it, Steve Jobs presented it in the first iteration of the Mac. He prettied it up. It looked a lot better, but he went on to say, before he died, if Xerox had known what it had and taken advantage of its real opportunities, it would have been the largest technology company in the world. The fact is, folks, Xerox saw something, Hewlett-Packard saw something, IBM saw something, but they didn't see its potential. Now, I don't know if after this webinar you'll jump up and down, leave the room, hyperventilate because you see something about housing wealth you've never seen before, but it is possible. So tell the people who are sitting close to you, if I start to break out in a sweat, just clear the aisle. For years, reverse mortgages have had a certain mythology around them, but particularly with advisors. Complicated, Don. They're too expensive. They're not for my clients. One fellow says, an equity stripper. I told him, Russ, I don't go to clubs like that. What's an equity stripper? He says, oh, it doesn't leave any money in the home. And it's a last resort. Don, I wouldn't tell my client to do it unless the fat lady sang and pigs flew. I reminded the man that I'm from Kentucky. I've seen a pig fly. The other week in February, I sent out an email to some folk who attended the Arizona Institute and heard me speak there for the Society of Financial Service Professionals. And a fellow wrote back this email. I stripped out the company's name. He says, so-and-so is an independent registered investment advisor. We manage a lot of families. They've got a lot of money. We've done a lot of research, and we don't feel this is a prudent strategy for any of our clients. That's what he told me. Reverse mortgages are not a prudent strategy. And I named his firm Einstein Nostradamus Wealth Management because of this. And their slogan is, we're really smart and know the future. Well, wouldn't you have to be really smart and know the future to say that this is not prudent for any of our clients? So 3 questions I ask advisors at the beginning of every session. And I ask them to be very honest with me. Don't fudge. You're not going to hurt my feelings. But the first question, I want you to think about this, write it down, and just say it. What percentage of your clients who are at or in retirement do you think would have a need for a reverse mortgage? Honestly, what percentage? Now, most people, when they're honest with me in person, will say 5 or 10%. Every now and again, someone will say 15 and 20, but it's usually around 10%. And my second question is, well, of those clients, what percentage of them would say they're 100% certain they'll have a great retirement? And someone will say, well, Don, who's 100% certain? I say, okay, what percentage would say they're 90% certain or 80%? And normally I get, Don, not very many, maybe 20. I said, all right, 20% of your clients feel that they have a relative certainty about having a great retirement. So 80% of your clients have uncertainty. They said, yes. Here's my third and final question. If there were a strategy that could help create cash flow, preserve assets, mitigate risk, ensure liquidity, and even add retirement dollars back into their savings, what percentage of your clients would want you to tell them about it? Well, 100%, right? Well, that's exactly what today's reverse mortgage does. It helps create cash flow, preserve assets, mitigate risk, ensure liquidity, and even add new investable dollars back into retirement savings. And 100% of your clients, if this is proven and true, the math and the science, 100% of your clients would want you to tell them about it. You see, what most people think of a reverse mortgage is like the 1997 cell phone I had. You remember your first cell phone? I had one in 1997, and I was the man. I was just going to go buy a convertible, just rent a convertible so I could look fancy. And it looked like one of them Osama bin Laden satellite phones in the desert. It was big, it was bulky, and it did one thing. And I was happy with that one thing. You know what it did? It made phone calls. Now, my son has had a mobile phone for 4 years. He's graduating here next month from high school. And in 4 years, I haven't seen him make or receive a phone call that I can remember. Yet we still call it a mobile phone. Now, if you're real progressive, it's a mobile device. But you know there's a world of difference. 2.8 million apps my son has access to. 2.8 million apps that thing could do. But the one thing it was designed to do, I've never seen him do it. So the reverse mortgage of old is like the 1997 cell phone. Today's reverse mortgage is like your iPhone or your mobile device. It does a lot more than you may have imagined. So the question, are reverse mortgages a product of last resort or a viable tool to be integrated? Is there a legal, more ethical, and compliant way for me to help my client access new retirement dollars that can be repurposed to increase retirement outcomes? How can I sell more homes, buy to more buyers in less time at higher price points? Those are for the real estate professionals who are joining us. And can I help retirees increase cash flow, reduce expenses, and add $100,000 or more back into their savings? That's a great question. This disclaimer is HECM seminars are to provide anecdotal and educational seminars. Consult your reverse mortgage professional or your financial advisor for the details. So retirement planning is like climbing this mountain. We know that. Hills and valleys, peaks and trolls, storms, and finally we make it to the top of the mountain. We plant our flag and we say, we made it, retirement. But the danger is not getting to the top. The danger really is coming down the mountain. You know of all the people who have summited Everest. 2/3 of the people who died on the way down. See, the danger is coming down Everest, not going up. The American College has summarized 18 major risks of retirement income, 18 major risks. I created a summary of those, and Curtis Cloak, I gave it to him. He developed it into this wonderful pamphlet. Jamie Hopkins turned it into a book. But the principles are the same. The risk in retirement, once you get to the top of the mountain, are exacerbated. Longevity risk, the risk of living too long and running out of savings, inflation risk, excessive withdrawal risk, sequence risk, market risk, whatever they are. And you can get all of these in the 10-page summary at 18risks.com if you like, 18risks.com free of charge. And so all of these are exacerbated. So today's advisor has to manage their customers' expectation, their goals. There are four primary goals that a customer has. They've got the longevity goal. Will I have enough money to meet my basic living needs? A lifestyle goal. Will I have enough money to maintain my standard of living? Legacy. Will I leave a lasting financial impact? That doesn't mean you left money to your children. It may mean you didn't borrow money, or you didn't have to move into their spare bedroom, or they didn't have to quit their job to take care of you because you were prepared for long-term care. And liquidity. Will I have access to tax-advantaged money when I need it? These are the four L's to which I tell advisors you should frame every conversation around this or something like this, which you already do. A fellow said to me, Don, I mentioned reverse mortgages to a client and they got very upset. I said, well, I'm surprised they didn't pull out a shank and cut you if they'd been in prison. I said, why'd you do that? I said, you hadn't been through my course, had you? If you had been through my course, I would tell you don't ever say the words reverse mortgage. Don't ever say that. And I say, please start with framing the problem. What was the problem when you sat with your client? They said, well, they had this mortgage, it was $1,800 a month. I said, and what was their concern about that? I said, did you ask them the question, what would life be like if you didn't have that mortgage payment? He said, no, I didn't ask him. I said, well, if you had, what would they have said? They would have said, well, I wouldn't have to draw so much from my savings, and I wouldn't be so concerned. I said, so they had a longevity concern. And they said, then the husband said, but if I didn't have that mortgage payment, I'd be able to play more golf. I said, so they had a lifestyle concern. And I said, so had you asked them and explored that, then you could have said something like this. If there were a way for us to eliminate the requirement of making a monthly mortgage payment so that you had enough money to preserve your savings and enough money to play an extra round of golf each week, if there were a proven resource for that, would you want me to tell you about it? See, that's a whole different framing, right? And then the couple would have looked at you with big eyes and tear-filled, and they would say, please, Tom, tell us. Tell us what it is. And you would say to them, a professor from the American College has been doing some teaching about the home equity conversion mortgage. Their eyes would have squinted, and they said, we've never heard of that. He said, a lot of people knew it by its 1997 name, reverse mortgages, but since the changes has been refined, it's now most often referred to as a home equity conversion mortgage, and it's able to do these things for you. And you said you wanted me to tell you about it. Here's what it can do. You see, framing the conversation. So the typical retirement picture has a client's income, their investments, and insurances, and out of that, you've got to create the four L's. Use a systematic withdrawal or a bucket, also known as time segmentation, or flooring strategy. One of those, or any hybrid of those, to create the outcomes we just talked about. But is that enough? Does that work? I don't think so. Because the face of the baby boom, these folks right here, you recognize these people. On Saturday, I was teaching a seminar, and I love doing this, and I said, who knows who these people are? And someone screamed out, the Rolling Stones. I said, nope, they're called the Strolling Bones. That's what one person said to me a few months ago. Well, a lot of us grew up with them, and now they're old. Baby boomers born between 1946, born in 64. 10,000 a day turns 62. We know that, but what we may not know is now 10,000 a day turns 70 and a half. See, that's significant because the qualified money that they have to begin withdrawing that. They've got minimum required distributions. They have to start taking the money out. They're going to live longer. They haven't saved enough. Up to 68% of them are carrying some sort of mortgage or home equity debts on their property, up to that many coming in. But here's the good news, folks. 87% of them will own a home in retirement, 87%. So that's going to be their lifeline. The Census Bureau said this: when we take out the outliers, those who make the most amount of money at the top and those who make the least amount at the bottom, and we have the average couple retiring today has $92,000 saved and $192,000 in home equity. Simply stated, the majority of the mass affluent boomers' wealth is in their house, housing wealth. You have to know what to do with it. CNBC said this: cash-strapped boomer, you can retire using home equity. Jamie Hopkins at the American College said retirees simply cannot afford to continue to ignore home equity as an income source and still meet their retirement goals. So the question for the hour is, how do reverse mortgages and retirement savings work together to enhance retirement outcomes and client satisfaction? So we're going to go back to the typical retirement planning picture: your income and your investments and your insurances, and we're going to add one thing to it: we're going to add housing wealth because 87% of your boomer clients own their home. And when we add that to the equation, some pretty fascinating things can happen. We're going to look at one of those fascinating things today. But before we start, a reverse mortgage. Some of you have been on this call and it's your first call with me. And you're not really sure what a reverse mortgage is. You've heard it. Maybe you've heard some ugly things. Maybe someone from Retirement Funding Solutions invited you to come on this seminar. What is a reverse mortgage? 4 words will help you. 4 words, and only 4 words, can really get the reverse mortgage out of spooky land. You know where spooky land is? Spooky land is that part of the theme park. I grew up Kings Island, Cincinnati, Ohio, and spooky land was that part where they had the haunted house and these other rides. And that was the part of the theme park that Mama said, don't go in the haunted house. Last time a kid got on that, he never came out. And just scared the wits out of you. And the financial theme park, that's where reverse mortgages reside for most people. They're not with the teacups or the Ferris wheels or the roller coasters. They're in spooky land where bad things happen. But if you can remember these 4 words, a reverse mortgage, folks, is just a mortgage. It's just a mortgage. Under the hood, when you look at any car that you see driving down the road, any car or truck, if you take away all the exterior, it's going to have 4 wheels, a braking mechanism, a steering mechanism, and some sort of engine. That's what it has. Then under the chassis, it's just a car. A reverse mortgage is just a mortgage. It's a federally insured loan that's 30 years old. It allows retirees age 62 years or better to convert their home into tax-free income. They don't have to make a monthly payment, but as you'll see in a moment, it could be very prudent to do that. They don't give up ownership or come off title to the home, and they're not required to repay more than the home is worth. Now, that's not for this seminar today, but on the screen, I do this for Retirement Funding Solutions typically every other week. I also do this for the Society of Financial Service Professionals, Insurance WebEx, and others like that. So you may see me around a lot of places. But today we're talking about the sleeping giant, which is right sizing. Have you ever had a client who's reached retirement, the kids are gone, they've got grandchildren, and then they're in a house. The house is wonderful, but maybe it's not the right house given their circumstances. See, a fellow called me the other day from South Carolina. I appreciate the call. Said, Don, I've got a client, they retired and they moved into a $600,000 home. Now, that's a lot of house in South Carolina in some places. But they took out a $400,000 mortgage, and that payment was $1,900 and something a month, and that was going to continue for the next 20 plus years. Well, what happened is, as they moved into this house, their eyes were bigger than their budget. You see, they didn't understand the power of cash flow. As the Harvard Business Review said, it's not the cash pile anymore, it's cash flow. So $1,900 a month, principal and interest, was a sizable amount of money. And by continuing to do this, it's put tremendous restraint on the longevity of their savings and the lifestyle they were experiencing. So I talked to the client and the advisor, very way I'm talking to you today, about helping their client to right size. So here's my client here, Mark and Linda. A few years ago, retired, 65 years of age, had $405,000 in savings, but they had a lifestyle that they were going to draw at $32,000 first year draw. How many of you know that's probably not sustainable? That's too much. They had a $535,000 home, and they had a $1,400 a month payment. Linda's primary concern was, I'm not going to have enough savings. If we keep living like this, we're going to run out of savings. Mark's primary concern was, well, I don't know if that's true or not, but I know one thing, I'd like to play golf more than just once a week. It costs me $48, and I go and get a hot dog and a beer with my buddies, and I don't want to do that just once a week. That was not part of my retirement dream. My retirement movie included me playing golf 2 or 3 times a week, and not just once a week. And Linda said my retirement movie included me having money in old age. You see the conflict there. And I said to them, well, what if there's a way, a strategy that I could increase your cash flow, reduce your expenses, and add more money back and more lifestyle? Would that be okay? And that's the question. You may want to hit print screen right on your keyboard pad. Here's a wonderful question. Would it be okay if we increased your cash flow? Stop right there. Do you have any client who would say, no, that's not okay? Would it be okay if we increased your cash flow, decreased your expenses, and added more money back into your retirement savings. Bob, Sally, Mark, Linda, would that be okay? Absolutely. So let me give you 5 ways we can do this. And I'll tell you what I did with my client. So right sizing. Some people say, Don, is it downsizing? I said, I try to avoid the word downsizing because people don't like that. That makes you feel bad. You tell your client, we're going to move down. You got to take a step down. It's like backwards. And most boomers don't like to think of that. So I call it right sizing. We're not going to downsize. We're going to get you to the right size. And maybe that right size is smaller than what you have now. So here's my client. They had a house that was $535,000. They had a big mortgage. So the first thing we did is we said, sell your house and pay off the mortgage. And they had $400,000 left over. You see that on the screen. They said, oh, Don, this is great. We're just going to buy a house with cash for $300,000. And a lot of the 55-plus communities, that had been their primary way of financing it, is people would downsize or right size, as I call it, and buy with cash. And so if they did that, $400,000 went to $300,000. They had $100,000 left over as a cash purchase. The benefits is you have a new home. You don't have any monthly mortgage payments, and you've got $100,000 left over. That's fantastic. A great strategy. Now, what's the downside of that? The downside is you now locked up all of your cash in that home. You just put $300,000 into the Titanic. Now, the Titanic was not supposed to sink. Captain said it's unsinkable. The builder said it's unsinkable, but it did sink. See, there are 3 dangers when you put all of your proceeds into the house. So first danger is 1990 or 2008 happened, right? 300,000 and your house gets smaller. It goes to 250 or 200. The second danger is you say, oh my goodness, I need to maybe get the money out of the house. And you discover public policy has changed, lending policies have changed, and you can't get the money out. You're not qualified. You had an income glitch. You had a credit glitch, and you can't get qualified to get the money out. A third danger is maybe the house decreases. You can't get money to get it out, or you thought maybe I can get 80%, but again, lending says you can only get 40% or 30% out of the house. Is it better to have your clients keep money outside of the home or inside? Outside is better. So Mark and Linda understood that, and they said, Don, we understand that. Whew, we dodged the bullet there. We'll go and just do a traditional financing. Okay, so the price of the new home on your screen is $300,000, and they go to a traditional lender, Bank of America, Chase, PNC, wherever you're at, Wells Fargo, and they're approved for $154,000. They said, great, I don't have to bring all my proceeds. We only have to bring $146,000. That's fantastic. And when they do that, Don, we had $400,000 and we only had to put down $146,000. We've got $254,000 left over. The benefits are they have a new home. The second benefit is they've got $254,000 left over. Does anyone know what the downsides are? I heard it in my mind that someone says, yeah, Don, but they've got a monthly mortgage obligation. They just sold the house to get out of that, and now they're back into that again. I say, yep, they are. And most people, even if they could afford to make the payments, there's a comfort level with that. There's a comfort level. So I told them about a program, the HECM for Purchase. And here's a buyer's guide on the screen, a 28-page buyer's guide. The person who invited you, ask them to send that to you if you've been to this webinar. You want to have that. You want to have that. I can send it to you digitally if you came from me. But it was a HECM for Purchase, part of the Housing and Economic Recovery Act of 2008, a new reverse mortgage, a special reverse mortgage. It was going to allow clients to buy a home, retirees, using the HECM as the basis. So here's how it works, folks. Mark and Linda sell their house. You've just seen this before. The house for $300,000. They don't want to make a cash purchase. They don't want to take out a monthly mortgage. They don't want to pull money out of savings. And so they get qualified for a reverse mortgage. The reverse mortgage, just like a traditional mortgage, makes available $154,000, so they have to add $146,000, just like the last example. So they've got $254,000 left over. Now, what are the benefits? The benefits of they have a new home. That's great. The benefits, they have no monthly mortgage payment. That's better. And the benefit, they've got $254,000 left over in cash. Now, let me pause here. Mark and Linda now have reduced, well, I'm going to go to the next slide on that. So take a look at this. Mark and Linda 2.0. After they spoke with you, and you spoke with the qualified reverse mortgage loan originator. Don't speak with just anybody with this. Please work with my partner firm, Retirement Funding Solutions. They do more HECM for purchases than anybody in the country. Their turnaround time is around 21 days if it's clean, and 30 days. I had a person the other day, they heard me speak. They said, can you help me with the HECM for purchase? I said, well, who are you using? They said, Don, I've had the appraisal expired. I said, wow, that took a long time to process. They said, this is the second appraisal. It takes 120 days for an appraisal to expire, and they had 2 that expired. So you want to work with folk that know what they're doing. So remember, Linda's primary concern, having enough money for retirement. Mark's primary concern was being able to play more golf than once a week. And our question to them, would it be okay if we increased your cash flow, reduced expenses, and added money back into savings? Let's see if this strategy helped to accomplish that goal. So number one, we eliminated their monthly mortgage payment. Remember that, $1,400 a month? That's gone. What did that do? That increased their cash flow, so Mark now can play more golf. Number two, we reduced their expenses. We moved them from a house that was $550,000 to one that was $300,000. So they've got lower taxes, less maintenance, a better situation all in all. So we've reduced their expenses, and we've given them more liquidity and some more lifestyle. And then finally, did we add money back into their savings? Yes, we added $254,000 back to their $405,000, so we increased their savings to $660,000. And remember, their first year draw was $32,000. Well, if we eliminate the need to have to finance a monthly mortgage, principal, and interest, we're able to reduce that first year draw to $15,200, or about 2.3%, well beneath the sustainable withdrawal rate. You see what we did for Mark and Linda 2.0? We did exactly what we promised, using a tool that put them into a much better retirement situation. We increased their cash flow, reduced their expenses, and added money back to their savings. So one of the questions that advisors say to me, wait a minute, Don, you're talking too fast, which is hard because I'm from Kentucky originally, and we don't talk fast. He said, wait a minute. What can I do as an advisor with the money that Mark and Linda saved? Is my broker-dealer, is the state insurance commissioner, the insurance company, can I use that money? And here's how I've answered this question since the program started in earnest in 2009. I said, well, what if Mark and Linda sold their house and they had $400,000 cash left over, and they went to an apartment? They didn't buy a house. They just said, we'll rent an apartment. And they showed up in your office with a duffel bag with $400,000. And you say to them, where'd you get that money? They said, we sold our house. We're moving into an apartment. These are just the proceeds from the sale of our house. Would you know what to do with that money? The answer is yes. Secondly, let's say Mark and Linda used the second strategy that we talked about earlier. They got permanent financing through a big lender, and they had $400,000 left over, but they didn't want to spend all that, so they got a loan for $150,000, and they had $250,000 left over, and they come to your office with $250,000 in the duffel bag. You say, where'd you get that? And they said, we got it from proceeds from a loan. Would you know what to do with it? Well, the answer is yes, I would know what to do with it. Well, because the home equity conversion mortgage or the reverse mortgage is just a mortgage, they have the same story. They show up at your office, they've got a duffel bag with $250,000, and you say, where'd you get it? They said, we financed a portion of our home using a reverse mortgage, and these are proceeds from the sale of our $550,000 house. You see, my friend, we've not had a single episode case with any broker-dealer, insurance manufacturer, or compliance person about this strategy. Aren't you glad you joined us today? Well, number two, right sizing is vertically. Same situation. You sell the home. They had $400,000 left over, but they don't want to go to a smaller house. They want to go to a vertical house. And they want to go to a bigger house. Now, this is Sam. Sam was a financial advisor. He sold his practice, and he was going to move to a house, and he thought his house would sell for $500, but it didn't. It sold for less, so he had $400,000 left over, and he wanted to go to the $500,000 home, and he said, Don, um, I was told to come speak with you. You could connect me with people who know how to do this. I said, how much is the house you want to buy, Sam? He says, it's $500,000. He says, Don, but I don't want a monthly mortgage payment, and I don't want to pull money out of my savings to do that. I only have $400,000. I said, Sam, that wasn't the question I asked you. The question was, how much is the house you really want to buy? He said, well, Don, the house I really want to buy is $600,000. And then he tells me again, but I don't want a mortgage payment, and I don't want to pull that difference between the 400 and 600 out of my savings. I said, Sam, that's why they sent you to us. I said, so the HECM for purchase for Sam, he was a little older, made about $313,000 available, so Sam had to bring $287,000, which means Sam, for $287,000 down, got into a $600,000 home. He didn't have to use any money from his savings, and he didn't have to make any monthly mortgage payments, and he had $113,000 left over to reimagine. Was Sam happy? Yeah, of course he was happy. He had never heard about this. Was the builder happy? Yeah, because the builder was going to sell a $500,000 model home, and they got to sell the $600,000 home with the walk-in bathtub. One of my clients says, Don, I'm getting a walk-in bathtub at $12,000, and it's going to be great. Now, maybe I got dropped on the head as a baby, I don't know, but I couldn't imagine a walk-in bathtub, and I thought, won't the water come out when you open the door? Well, when they built the house, I went out there and saw it, and if you haven't seen one, they're fascinating. I just wouldn't want to sit in the toilet or in the thing as it's filling up. It had to drain fast, but it fills up. I'd be cold by the time I got up to the top. So Sam was able to do this and add money back into his savings. Powerful, powerful. The benefits, no mortgage payments, and $113,000 left over, and he didn't pull any money out of savings. Well, number 3, right sizing by making a lateral move. This is Bill and Mary's story. Bill and Mary sold their home. They had $400,000 left over, and they don't want to go up or they don't want to go small, but they just said, look, I've got steps and a 3rd floor and 5 bedrooms. I'd like a condo and a townhome and a 1st floor master suite and laundry on the 1st floor and all of that. So they said, hey, the new home is $400,000. We have $400,000. This is great. We'll just pay cash. But you know the 3 dangers in having your client pay cash, right? So they used the HECM for purchase. It made $213,000 available, and therefore they only had to bring $187,000. So Bill and Mary had a lateral transition, 400 to 400, but they had $213,000 left over. The benefits, no monthly mortgage payment, and $213,000 left over. They're happy. Their advisor's happy. The real estate professional is happy, and they didn't lock up all their proceeds in uncertainty, you see. Now, the last 2, before I take questions, are part of the hybrid strategy, and I'm particularly excited about these, but let me tell you how to really supercharge your clients' outcomes. Number 4, right size and take advantage of tax-free growth. Right size and take advantage of tax-free growth. Now, the blue line here is the market January 2015 to January 2016. If you had 200,000 in during that period, you had 197. It was a bit of a roller coaster ride. I like roller coasters. I used to ride something called the Beast, which is still at Kings Island right outside of Cincinnati. And for the longest time, it had the distinction of being the highest, longest, fastest all-wooden roller coaster in the world. I loved that roller coaster. But I didn't love it as much at age 51 as I did at 15 or 12. It almost broke my back the last time I was on that thing. And so the green line shows one of the uses of the reverse mortgage, which is the line of credit. The reverse mortgage has a built-in guaranteed growth factor for the line of credit, which today is around 6%. Let me show you how this looks. A $200,000 home will produce a $100,000 line of credit, and left untapped, in 30 years, 31 years, it's grown to $608,000. I'll show you a $400,000 and a $600,000 home. So notice these homes. Across the top, we've got 100, 204, 311. That's the line of credit numbers. And this growth factor says, and this comes right from the amortization table that the federal government requires that every person who gets a reverse mortgage gets an amortization table showing the line of credit growth. That's not an addendum, that's a requirement. And it shows that the line of credit can grow to these numbers. So that's powerful because it's tax-free, it's growth, it's guaranteed, growth factor. The line of credit cannot be canceled, frozen, or reduced. It grows regardless of the home's value, regardless of your income, regardless of credit or credit glitches. You have this growing line of credit. That's another webinar. That's not today, but it's important for you to understand the power of establishing or helping your clients establish a growing line of credit. So back to the HECM for purchase. This $400,000 home, they buy $300,000, and the HECM for purchase made $154,000 available. We've seen that already. Now let's talk about a hybrid way to do this. So the client had to add $146,000. Now, remember your client had $400,000 left over, right? They only have to bring down $154,000. Don, what if they bring more? They had $400,000. What if they bring more? A couple things happen. If they bring more, then we're able to establish a line of credit. Here's what it looks like. The client puts down $270,000 versus $146,000 of the $400,000 they had in proceeds. So they bring more. That means they've got $130,000 left over in repurposable cash, right? $400,000 minus the $270,000. But in addition, because they put down more, they've established a $124,000 growing line of credit, which was the $270,000 down minus the $146,000 that was required. That was the minimum required. But they put down more. So now, look over to the left. You've given your client a line of credit, $124,000. That's growing at 6%. They can use that. They can pull it out. It's bidirectional. That can be used for all types of things. The cost of doing this is significantly lower, because that's the way the government has structured it. So you've given your client $130,000 out, that's the duffel bag to you, and $124,000 in. That's the guaranteed growth to them, and the minimum guarantee today is around 4.5%, but it's actually growing closer to 6 today, you see? So you're able to do some pretty creative retirement income planning with this hybrid strategy. So let me give you the last one. So here's what the hybrid strategy, here's the screen for the hybrid strategy. It's pretty. I like the colors. I picked them out. So the benefits are you have a new home, no mortgage payment, you got $254,000 left over. You could structure it as cash out, cash in, give your client the line of credit, and it's a lower acquisition cost when you do it this way. So here's the final one. The final one. This is fantastic. It's powerful. So let's go back to the client. $400,000, $300,000 for the new one. They've got money left over. You see that on the screen. So we know that. Now the question is, well, Don, what if Mark and Linda want to make a payment? Why in the world would a client want to make a payment? Well, they may want to make a payment because they were used to making a payment. And you say to them, well, let's make a small payment, and it doesn't impact their cash flow. There are plenty of folk that can make a payment, and I'm showing you why they may want to do this. So take a look at this, and then I'll take your questions. How does making a $1,200 a month payment work? Well, Mark and Linda have a $300,000 home. That's their new home, right? And the reverse mortgage, the beginning balance plus closing costs. So the principal limit you see on your screen, the $162,000, and the outstanding balance are the same. So they owe me $162,000 from day one. So the line of credit, which is principal limit minus outstanding balance, is zero. They don't have any money in the line of credit because they gave you $254,000, and that's fine. So we say to them, let's make a payment. So here's how the reverse mortgage works, folks. The principal limit is going to grow. I think I'm using 6% here. And the outstanding balance grows. But at the end of the year, or however they want to structure it, they make a payment of $14,400 a year. So principal limit, which grew, outstanding balance grew, but they paid it down. So now they have a line of credit of $14,400. They're going to continue to make a payment. Watch this. Years 1, 2, 3, 7, and 11. So year number 11, they made a monthly payment of $1,200 a month. At the 11th year, their balance, what they owe, is $100,000. But look at their line of credit. Remember, they've already given $254,000 to you. They've made a payment, and now they've created a new line of credit in year number 11. So they're 76 years of age right here. Let's see if I take it out a few more years. All right. So their payment stops, and we have year 13, 17, and year 20, their payment stops. Now we'll go out to year 25 and year 30. So these are the out years, 20 years later, right? They're 85 years of age. They're in their out years. But not only do they have the $254,000 that you've done something with, they now have an accessible line of credit of $519, $695, $930,000. There's been some talk amongst HUD with the new administration of putting a cap on this at some figure, maybe 1.5 times the home value. But the principle still stands. By making a payment, they've created a deferred income stream, something they can access for home care, health care, unexpected expenses, X, Y, and Z. And how did all this happen? It happened because one day you attended a webinar. You heard something. You listened to a recording. And the recording said that 87% of baby boomers have a home. And the National Association of Home Builders and Merrill Lynch also confirmed this in a study they did with AgeWave, that more than 50% of baby boomers are open to moving and relocating. They don't know how, but more than 50% are open to moving. Now imagine that your clients, you're talking to them about the 4 L's, not about reverse mortgages, about longevity, lifestyle, liquidity, and legacy. And they're concerned. And you can help them to right size and reimagine by downsizing, I don't like the word, but vertically, laterally, using a H for P with a RELOC hybrid. RELOC stands for reverse mortgage line of credit. Or H for P with a monthly payment because they can afford to, creating some efficiencies in the out years of their retirement. Any of these 5 ways is accessible to you, and the dollars that are garnered from this could be tremendously important. I'm going to take a few questions now. We've got 1:45. That's great. We're right on time. And I want to take a few questions. I heard a statistic yesterday from my new friend Steve. I don't know if Steve's on the call or not. And I've got to get the statistic because it just blew me away. I'm going to unlock my question dialog box here. And I see Steve is on the call. But Steve said he was talking about advisors and something to this effect. And as soon as I get it, I'm going to start teaching on it next week. That of the people who left advisors, went to another advisor, and that happens, right? Erosion and attrition. But of the people who left advisors, somewhere around 78% of those who left said they left because the advisor added no value to them. Meaning the advisor was interested if they had a new product, we wanted more life insurance, more this, more that, more managed wealth. But apart from products or services that benefited the advisor directly, 78% of the people who left the advisor said, I left because they added no value to me. You see, housing wealth adds value to the client. The conversation adds value because it has so many tentacles. I just gave you 5 tentacles. They're about 31. But I've given you 5. By being able to create conversation in ways that can help your client increase cash flow, we showed you how to do that. Preserve assets, we show you how to do that because we prevented such a drain, and we gave them some more money with the line of credit. Reduce risks, we did that because if you set up a line of credit, you can draw from that during the down years if you've had managed wealth, not cannibalize that asset or lock in the losses. Ensure liquidity throughout retirement, we showed you how to do that. And add new retirement dollars back, investable dollars back into your client savings. 5 things. 5 things. So where we started at the beginning of the presentation And the third question I asked you, if there was a way, a proven way, that you could help your clients increase cash flow, reduce risks, preserve assets, ensure liquidity, and add new dollars back into their retirement savings, would they want you to tell them about that? And you all nodded your head, yes, yes. I could see it. I can see you from Greater Philadelphia. You nodded your head, yes. And so the new reverse mortgage, friends, is not the 1997 cell phone. It's the 2017 iPhone with 2.8 million apps, and it does so much more. It's part of the retirement income conversation. So let me answer a few questions. You've got a question here. We've got a few minutes before we hit the top of the hour. I've got 5 questions, but I want you to write your question here over the question box. And it takes it a minute to get here, so type now. And if you need me to go back or reemphasize something, have me do that. There's a certification course that we will start hopefully in September. Well, we'll put this all in a 4 or 5 hour segment. There'll be an exam, and you can be a Housing Wealth Certified Advisor, because this comes up very, very often. A fellow called me. He was faculty at North Carolina University, or Duke. One's in Raleigh, one's in Worth. He called me. He said, Don, I looked at your PBS. I found you online. I watched your PBS special. He says, I've called several advisors here. None of them know what you're talking about. He said, do you have any advisors in North Carolina who know anything about how to use housing wealth to increase retirement efficiencies and outcomes? I said, I do. Well, that happened the other day. This happens all the time. Someone will see me, someone will call and say, Don, do you know any advisor who knows this? The Retirement Income Summit, sponsored by Investment News, was just held in Chicago, I guess a week and a half ago. And as some of our team members were there, what they came back with was, out of the 400 or 500 people, and then we had a whole bunch of folk there, because the task force, the Funding Longevity Task Force, which studies reverse mortgages, as a guest member for 4 years, is now part of the American College. And they said what advisors knew or did not know about reverse mortgages and the misconceptions they had was stunning, was absolutely stunning. So let's take a few questions. I see you're, go ahead and add them, type them in now, and I'll take 10 minutes and answer these. Tevis, hey Tevis, afternoon, Don. Afternoon to you, Tevis. Russell, hi Don, see you in Oakland. Yes, we will, Russell. Maybe we'll play some golf. Joe, had to leave for an appointment. Don, send me the recorded version. Thanks, Joe. Steve says, what if a couple gets a HECM and they want to move a few years later? Can they only have one HECM at a time? Steve, this is a fantastic question. I hope you are listening, because I didn't add this to today's webinar, but I had intended to. So here's the question. You can only have one HECM at a time. That's the short answer to that. But once you get a HECM, so let's go back to Pierce and Linda, right, in the story. Pierce and Linda get this nice house, but Pierce dies 10 years later. Linda's 75, and she says, well, this has 3 bedrooms. This is too big for me. Now, Don, can I sell this house and do it again? I say, sure, Linda. You got a $300,000 home, and now it's 10 years later. Let's just say the house was worth $400,000, and you owe me $200,000. That's what it had accrued to, right? So Linda sells her house for $400,000. She pays off $200,000, and she's got $200,000 left over. From being on this call, you all know the answer to this. If they've got $200,000 left over, Linda now can buy a house twice, 2 times the proceeds. So she can go and buy a house for $400,000, or she can buy a $300,000 house. So Steve, she's not stuck. She's not stuck there. But here's something that came in. Oh gosh, I'm going to write an article about it. So you'll see it on AskDonGraves.com. But a fellow from South Carolina called me, Georgia. He was over in his South Carolina office and with a client. And he had heard a piece of this. He's not on the call today, but I was so impressed because he called me right on my phone. He says, Don, I've got a client here with me. This is Dr. and Mrs. So-and-so. And I said, all right. He says, hey, listen, if they sell their house for $400,000. They have $400,000 left over. They can buy a house here, still where they live. They want to buy a little $200,000 house, little jobby. I said, yep. They said, now they can get that for about $100,000 down with that HECM for purchase. I said, yes, sir. So they've got $400,000 left over. They buy a $200,000 home, little jobby, there with the grandchildren. And Don, they're still going to have $300,000 left over. I said, yes, sir. He said, can they take that leftover money and buy a condo down in Florida? They want to go to Florida. I said, yes, sir. They can do whatever they want to do with the leftover money. And I heard Dr. So-and-so said, that's what we're going to do. See, it's called buying two for the price of one. So they're going to get a house there with their grandchildren down in Charleston area, a little jobby, and then they're going to get a big house, $300,000, and they didn't have to pull money from savings. They didn't have to take out a monthly mortgage payment. They simply used a strategy that the advisor heard me speak about to help his client. Matter of fact, that guy's called me 3 times in the last 2 weeks with an advisor, with a client who was sitting in their office. He says, I don't know about it. Let me call my buddy. And he just gets on the phone. And I would encourage you, the person who invited you to this call, make sure you get their mobile phone number. And when you're sitting in front of a client, just say, hey, wait a minute. Let me get my buddy on the phone. So, Steve, that's a great question. Barbara, is HECM interest deductible on Schedule A? Barbara, we're required to say, please consult your tax advisor on that. And so the answer is, there's an article written. I'll post about it this week. Michael Kitchis wrote this. I don't know the answer. Here's what I do know. If you're making a payment, if you used option number 5 that we talked about, and you make a payment on a reverse mortgage, actually send a check in, there's some tax deductibility on that, just like a regular mortgage. But other than that, Barbara, make sure you email me, and I'll send you Michael Kitchis' article. Renan, hi Renan, the line of credit growth at 6%, how much does it cost? Is this arbitrage? Renan, I'd like to tell you that I knew what those big words like arbitrage mean, but because I'm not a financial advisor like you, I don't know that big word. I mean, one time someone told me at a conference I could get residual income, and I thought that was the stuff me and my cousin left in the bathtub when we got out, residual. So, Renan, I don't know the arbitrage. I used to hear Curtis Polk and Tom Hegna talk about that. How much does it cost? Those questions I can ask. But what I want you to do, Renan, email me when this is over. If you came from me, just reply Don, and we'll walk you through a specific case study. Renan says, I'm in North Carolina. I hear you. Steve says, check your email. I sent you some stats from the survey. Hey, Steve, that was great. You see, I was paying attention the other day. And Steve's my buddy down in Texas. Boy, I'm telling you, Steve got his hands on something really good, and I'm excited about that. Javier, hey, Javier, here's your question. Don, you mentioned a joint meeting of advisors in Diablo Valley, NAFA. Hey, Javier, yep. And I'll be there next Friday, not this Friday, next Friday. I'd be able to attend. Good, Javier. I'd love to see you. Maybe we'll go out and do something afterwards. So come on and join me. But email me. It's at some country club out there, but it's a joint meeting with Silicon Valley, FSP, and a few NAFA folk. Do that. Now, Renan, is this residential? Can it work for commercial property? Can I do reverse mortgages on purely commercial properties, Renan? You can do a reverse mortgage if the property is mixed use, and if the commercial side doesn't take up, I think, more than 25% of the mixed usage. And, yep. Moses, hey, Moses, how are you? Don, please send me a replay link for this webinar. I joined late. Okay, Moses, I'm glad you joined. I'll do that. Cornell, how can we make money using the HECM? Thanks, Cornell. I get this question a lot, and it may be a good one. I've got 3 minutes left, folks, so if you got a question, fire it up. Remember, it takes about 60 seconds to get to me, so send it over, and no matter what it is, I will respond if you get it to me. So Cornell asked the question, Don, how do we make money using the HECM? So Cornell, I'm going to answer that in 2 ways. I'm going to make an assumption that you're a financial advisor. And so here's how the financial advisor, 2 ways, and every week, almost every day, someone says, Don, how do I make money? So the question is, if you're asking me, Don, can I make more money by implementing a HECM strategy into my practice? The answer is yes. if you're saying, Don, I want to do what you do, and the folks on this call, I was an orthopedic surgeon, but I want to now become a proctologist. I said, okay, you didn't go to school for that, but there are ways to do it, and I would discourage that, Cornell. I've got very strong opinions. I've had those opinions for 17 years. That financial advisors, when you do this, you put a big target on your back. The CFPB, Dodd-Frank, Claire McCaskill, your state legislators, and the regulators. You're going to have a target on your back. Now, I do point people in the right direction who says, I don't mind having a target on my back. And I said, well, I can't help you. The firm I partner with and the bigs won't do it, but there are others who will. But there may be a different way, Cornell. See, the point is, advisors, think about this, annuity providers, just with a big guy today, and they do it all over the country, a big firm. And I said, what's the biggest obstacle when you're folk in selling annuities? He said, Don, they're always hunting. Their biggest obstacle is finding new clients. I said, okay, I can help you do that. What's the other obstacle? He said, that's it. I said, that's not it. You can find someone who has $100,000 under the mattress and $100,000 in a CD earning 0.1%, and you can tell them about all the great stuff you have, and that couple won't move a nickel. They won't move a nickel. I said, why won't they move a nickel? And he says, because they have a fear of, and he told me. And I said, I'm going to show you how to alleviate and eliminate the biggest obstacles to people purchasing annuity and long-term care. And once your folk understand that, he understood, he said, then they're going to outsell the person every other day. I said, so would it be okay if I gave you a $50,000 a year strategy? He said, you can give me a $100,000 a year strategy. See, Cornell, so that's the difference. You can email the person who invited you. You can email me, and I can tell you how you can do that. All right, last two questions. Here we go. Samantha. Hey, Samantha. Hi, Don. This is Sam. I won't pronounce your last name. Would you please send me a replay of the webinar as well? Samantha, I'm supposed to be coming and doing a workshop for you because you're in Florida, and you and your wonderful husband and your broker-dealer said we can do it, and it's going to be spectacular. So to answer your question, yes, of course I'll do that. And Chad, we'll end with Chad unless one more comes here in the next 30 seconds. Chad says, Don, can you send me a replay of the webinar today? Chad, when I hang up from this call, it's being recorded. I'm going to say save the recording. And then I'm going to say to the people who are on this call, send this recording to those people. And just in case GoToWebinar messes up and you don't get it, I'll know and I'll send it to you personally. So if you don't get a recording from me, just email me or the person who sent you this, and we'll get you all situated. Folks, we're at the 2 o'clock hour. 5 ways the HECM for purchase is changing retirement. 87% of baby boomers own a home. More than 50% are open to moving. And they have not saved enough. They're living longer. They're in debt. Here's one strategy, folks, that if applied, makes a tremendous difference, not only in their life, but you get the only legitimate way that dollars can come through a HECM strategy that won't cause you to be arrested or put in jail or have your license revoked. All right, I'm going to stop the recording right now. Email me or the person who invited you if you have any questions. Thanks again. In 2 weeks, we'll be back here again talking about one of the national leaders in long-term care. Will be with us in 2 weeks. You'll get an email from me or the person who invited you. You want to be here for that. That's going to be a great webinar. Bye now.